The other thing that's going on is the consumer is railing against these price increases. Consumer sentiment, as measured by the University of Michigan, which we think is the best measure out there, is down to record low levels, below 0809, below 80 and 81. I had just started my career and inflation and interest rates were in the double digits, 15, 20%. And consumer sentiment today is lower than it was back then.
ARK Invest CEOs and founder Cathie Wood is one of the few market experts who held on longest to the possibility that the U.S. economy was not going to slip into a recession despite the record high prices, existing supply chain issues, and interest rate hikes. However, in her recent interview with CNBC, Wood seems to have taken a different stance as the economic decline appears to be worsening. Many forward-looking indicators which Wood previously stated seemed positive have taken a quick turnaround. After an 8.5% consumer price index reading in March, things seem to be improving slightly until we dip down to 8.6% in May. Other economic indicators, including the Purchasing Managers Index and the Consumer Sentiment Index, are also at record lows. In addition, the International Monetary Fund, IMF, says it expects an overall global economic decline in 2022. In her interview, Cathie Wood discusses her ARK Invest stocks, most of which are down. She also speaks about the things she might have done differently considering the economic decline and the war in Ukraine. Please watch, like, and share this video, and don't forget to drop your comments below and subscribe to the channel. We deeply appreciate all our viewers and subscribers for their time.
The Federal Reserve had a lot of money out there. It pushed investors into riskier assets, and now we've seen it come back down. The Federal Reserve is tightening funds. You may not see money supply like that out there again, so it may take years for some of these companies to grow into the stock multiples or the stock levels that they had seen at earlier times. What do you think about that thesis? What makes you think we'll get back to those higher multiples?
Well, we don't need the higher multiples. So we have a 5-year investment time horizon. Just to give you a sense, for our flagship portfolio, our enterprise value, so that's both equity, market cap, and debt, enterprise market value to EBITDA, so effectively cash flow, is around 69 times. So I know a lot of people say profitless tech. We are not profitless on balance. We make the assumption that in 5 years, that number will be close to the market multiple on that basis, which is roughly 16 times. So in our models, and we're starting to publish our models because we really want people to understand this. We just published Zoom, we published Tesla. You can find them on GitHub. Experiment, change the variables we think will move the needle. And you can see how your assumptions might work into our 5-year investment time horizon. So we assume a 20% annualized headwind from declining valuations. And so our return expectation, which is quite substantial right now, is based solely on revenue growth and rising profitability. Now, the narrative you just gave, many people cite when they're talking about the tech and telecom bubble and bust. And we've analyzed our portfolio relative to that as well, because there are memes around that. It's astonishing to us that Zoom's revenue since the coronavirus is up roughly 6-fold, and the stock is almost down to where it was pre-COVID. Same with Teladoc, up 4-fold. Tesla up 3-fold, although Tesla has, now that it's in the indexes, it has held up better than the rest of our portfolios. But that narrative in 2000, if I could just say, it would suggest that by now we would be seeing negative revenue growth in our expectations for the next year and declining gross margins. We are seeing the opposite. We're seeing north of 25% revenue growth. If you're just using consensus estimates, it's 25. And our estimates are much higher because we're focused on exponential growth trajectories being driven by powerful new technologies.
Wood also talks about things she might have done differently with her picks for the investment management firm. She explains that while the team did every other thing right, they were wrong about inflation and the direction the economy was taking. Please listen to Cathie Wood as she speaks about inflation, consumer sentiments, and the added effect of the war in Ukraine.
We were wrong on one thing, and that was inflation being as sustained as it has been. Supply chain, I can't believe it's taken more than 2 years. And Russia's invasion of Ukraine, of course, we couldn't have seen that. So inflation has been a bigger problem, but I think that it has set us up for deflation. I've been listening to your program. I heard Ken Langone talk about being in recession now, Jeremy Siegel, same. We think we're in a recession, and we think a really big problem out there is inventories, the likes of the increase of which I've never seen this large in my career. And I've been around for 45 years. And we're talking about the best managed companies in the world. If you're talking about Walmart and Target, they know how to manage supply chains. So if they have problems, we think there are a lot more problems. And then the other thing that's going on is the consumer is railing against these price increases. Consumer sentiment, as measured by the University of Michigan, which we think is the best measure out there, is down to record low levels, below 0809, below 80 and 81. I had just started my career, and inflation and interest rates were in the double digits, 15, 20%. And consumer sentiment today is lower than it was back then. And most interestingly, in the last report, many people think, oh, the heavy spenders will keep this thing going. Consumer sentiment in the highest income groups is lower than in the lowest income groups, and the latter group is being, tormented by food and energy prices, which are really a regressive tax increase here to them.
With so much fear, uncertainty, and doubt in the market, it is difficult not to feel some form of anxiety. But that is what happens during all bear markets, and all investors, especially in the crypto space, must expect some form of volatility sooner or later. But this is just a part of the market cycle. The other part is going to come around sooner or later, and it is going to be even more profitable and liberating than it was previously with the increasing adoption of cryptocurrencies worldwide. What do you think about Cathie Wood's interview? Please drop your comments and observations below, and don't forget to hit the like button. Thanks for watching.